This is Radio Free Wall Street with Lee Adler, on the web at radiofreewallstreet.fm and wallstreetexaminer.com. Hi everybody, this is Radio Free Wall Street for Monday, August 4th, 2014, produced and recorded that day. I think that now more than ever, given what happened in the market last week, is an important time, a very important time for us to take a close look at the market charts to get an idea of where the market might be headed in the short run. We may have gotten an answer to that today. And also what that break last week might imply in terms of both the intermediate outlook and the longer term outlook. So we're going to take a look at the charts from the weekend edition of the Wall Street Examiner Professional Edition Market Update. I know if you're watching this video that there's a good chance you already subscribed to that. So that I hope this provides some color and fills in some of the blanks from some of the things that you're looking at and reading. And if you don't already subscribe to that service, again, I think we are now in one of the most important junctures in the market that we have been in for a long time. And now more than ever is an important time, a crucial time to understand the market's technical underpinnings, not just the liquidity factors, but the technical factors on the chart. So if you don't subscribe to that service, this would be a good time. Go to wallstreetexaminer.com. If you've never tried it before, you can do so risk-free for 30 days. Before we get to the charts, the liquidity situation looks a little bit tight in August. One thing that I missed in recent weeks prior to this was that the TBAC, the Treasury Borrowing Advisory Committee, expects the Treasury to float $50 billion in short-term cash management bills in August. That's going to turn the liquidity situation, if they do that, that's going to turn the liquidity situation very negative because, of course, the Fed has tapered QE again, and the gross amount of Fed purchases is only going to be around $45 billion per month now. So with $50 billion of additional Treasury purchases in August on top of what's already expected, the QE is going to fall way short of what's needed. So at best, I think that from a liquidity standpoint, August looks like a very choppy time, and we're going to see days that there's some downside pressure. Whether it'll be as bad as last Thursday or worse, I don't know yet, but let's take a look at the charts and maybe that'll give us some ideas. With the market just having had quite a downdraft last week, let's take a look at a half a dozen charts from this weekend's Wall Street Examiner Professional Edition Market Update. We'll start with the third rail chart, which I have shown you in the past, and it's based on linear regression standard error channels. And what I do is I choose 2 points, generally lows or highs, and I draw a linear regression between those 2 points and then project that forward as a standard error channel. So for example, the April low here would be the first point in an intermediate channel, and then the second point would be in early May. Those 2 time points would create a linear regression and then a standard error channel, which is then projected forward. And when you can see that last week we broke that channel right here, and we had quite a downdraft, and there were some other channel lines, a short-term channel here, and multiple other channels that were broken quite severely. Then the market fell on Friday to an old projection of the center line or a linear regression connecting a couple points between this very minor low here and then a second minor low over here. So that projected forward. That channel was briefly broken, but we find that many times these extensions of these old channel lines do represent support or resistance. So we got a little bounce, and I'm looking at the chart here at about 1 p.m. on Monday. The market is attempting to rally again from this area. So we've established a minor support level here. Not shown on this chart is another trend line, which I'm going to draw in for you to see. And as you can see, that came through at around 1940 on Friday, and that was broken decisively. So we've established minor support around 1920-25, and this brown line is a long-term trend line extension, either a center line or a lower channel line. And it may be resistance now. We'll have to see how the market does the rest of the day today, whether it can get above the 1935 area. It's having some trouble in the first half of the day. Then if it can, the next resistance level would be up here around 1940. If it fails to get through this 1935 area and challenges 1925 again, and if that breaks, then we have an air pocket indicated on this chart down to around 1890 or so in this area here where the next support level would be. So that's a look at what I call the third rail chart. Next up is a daily chart of the S&P 500, a cycle chart. And let's take a quick look at the cycle indicators at the top of the page. At the very top, you have 10-12-month cycle momentum. It's a rate of change indicator with a time period that's designed to show the 10-12-month cycle. But the market has been oscillating in such a narrow range that it hasn't really shown that, but there was a couple of things that happened. First of all, in early July, I pointed out at the time that the momentum had reached the peak levels where it had topped out in March and also back in November, and each time that led only to a short-term top. But then at the second peak here in late July, we got a significant negative divergence. And we all know by now that negative divergences haven't really meant much in this bull market. And maybe this time, once again, it won't mean much. But the indicator then broke a 4-month-long trend line, which suggests that the 10-12-month cycle is topping out. And then it ticked below on Friday, this trend line going back to last October. So that's 9 or 10 months now. That's not a material break. So if it holds here, this could be a bottom, just like it was in April. And just like when the first bottom formed back here in October. So if this holds in this area over the next few days, then maybe we have another intermediate bottom. But if it continues lower, that would have longer term implications because of the breaking of an uptrend that has persisted for 9 months. You can see that the 6-month cycle oscillators have rolled over. Up here, this is a 10-12-month cycle oscillator, and it's all out of whack, so we're not going to pay much attention to that right now. But these downticks in the 6-month cycle oscillators suggest a top. Now, how long is the down phase going to last? Well, the last bottom of this cycle was apparently back in early February, and if you count 6 months out from that, that brings us to right now. This little sell-off we just had could be all she wrote on the 6-month cycle down phase. It's due, ideally, for a bottom in this area. So the cycle could shift, and we could see it come down to 1900 and rebound there, or maybe it'll hold here and continue to trade sideways. But it's possible that this is all she wrote on the 6-month cycle down phase. We'll have to see over the next few days or so how this rebound that we're in today, whether it hangs on and amounts to anything. It needs to build a little bit of a base at least, either here at 1925 or maybe after a final downdraft to around 1900. And then we should get another 6-month cycle up phase. The shape of that rally, that next rally, is going to give us some clues about the longer term. A weak rally that tops out below this area here, 1950 to 1970, would create a classic right shoulder. However, anything higher than the 1955-60 area of the left shoulder probably would invalidate any negative implications of a head and shoulders pattern that looks like that. Normally, if a head and shoulders pattern is going to amount to anything, the right shoulder is usually weaker than the left shoulder. Ideally, for a really bearish pattern to develop, this sell-off might pause here and then come down a little bit lower to 1900, and then you would get a down-sloping neckline. Say if the next low is down here, then you get a down-sloping neckline like this. And then you get another rally up to the lower to mid-1900s, and then another drop down here. So that's what the ideal would be if a top pattern, a significant major top pattern, is to develop here. And that's going to take some time. bull markets normally don't top out in 2 or 3 months. The top patterns usually develop over a lengthy period of time of anywhere from 9 to 18 months. So that's what the cycle chart looks like here. Again, support either here in the 1925 area or possibly down to around 1900 before we get a rebound. And the size and shape of that rebound will give us some hints about the longer term picture. Next, let's take a look at standard error channel linear regression chart of the Dow. And it's a similar picture. We had a breakdown of a multiple trend line area in here late last week on Thursday. And you can see it crossed pretty much of an air pocket in this area down to about 16,650, 16,600. Then Friday we got a little bit more downside. Once again, we had a couple of old trend lines which converged here to just above 16,400, and that's pretty much where the decline stopped. And today we're rallying back from that point up to about 16,520 here at close to 2 p.m. Eastern Time on Monday. So this area here at 16,400 looks like it'll be support, at least in the short run. If it does break over the next couple days, then we're looking at kind of a rather sizable air pocket down to about 16,100. If this 16.4 holds and we begin to rally, look for resistance around 16,650, 16,700. And if the market fails to get through that, then I think we can probably expect a bigger decline. If the 16,700 area doesn't, say 16,750 doesn't present too much resistance, then we can make a run back at this congestion area around 17,000. Next, long-term chart of the S&P 500. First thing we notice is this trend line from the 2011 low has had a minor non-material break as of last week, and today it's back to the trend line. If it closes the week 1935 or better, then there's no break. But anything below 1930 or so would probably be a clear break of this trend line and would open the way for a drop to the 1890, 1900 area on the S&P, where you have another very significant support line that should generate a minor rally. That squares with what we just saw on the short-term chart. So this trend line is the key right now. At this point, there's no threat of a break of the very long-term trend line, this one here that goes back to before this chart started, to the 2009 low. And that right now is down around 1820 or so. So I don't see an immediate threat to get this low this soon. This area here the market needs to do some filling in of this space up here, and then we could get a break later in the year that begins to trigger the first signs of a real bear market. Ultimately, these channels that have all been going up in a straight line should begin to roll over and turn at least flat, which could open the way for a decline as low as 1700 in the first leg of the next bear market. But that's getting way ahead of ourselves. First things first, we have to build a top up here. Let's run down some of these momentum indicators. The long-term momentum peaked in 2013. It's still very strong. Like here's the zero level right way down here. We're all the way up here close to the 60-70 area. However, we're threatening a 4-year trend line at this point. Breaking that might not mean much, but breaking the shelf here, say right along this area, if that were to break, I think that would be an important signal. And we see similar levels, say, on the 2-year cycle momentum, which has shown a steady loss of momentum throughout this bull market. And over the past year or so, very slight, imperceptible slowing of momentum that could ultimately be a sign of weakness. But the negative divergence doesn't mean anything yet. When will it mean something? Probably when this line of lows is broken. The 3-year cycle momentum, we see something very similar. We've reached the long-term trend line here. A break here, I think, would be meaningful. Here's the first shelf that we want to look at, just a little bit below current levels. If that were to break, I would take that as the first real sign that we are entering a bear market. 10-12 month cycle momentum diverging for the past year and actually diverging for the past going on 5 years now. But once again, we're looking for this shelf area, which is right around here, or say drawing a straight line between these lows, not too far below current levels. And if you get say a little bounce from around the zero line, one of the things about momentum indicators is that when they reverse direction from near neutral, that's usually a sign that we're going to get a big move. So if we get down here to the zero area and begin to turn up, probably get a pretty sharp rally. On the other hand, if we break through the zero area and head down here, then we're going to get a big sell-off. But right now, this area up in here, we have to see more of a, I think, more work done in this whole area before we get real excited about the potential for a big bear market. And certainly, I don't see a crash on the horizon. Normally, crashes develop out of what appear to be bottoms. They don't come straight off the very top of the market like we just have over the past 6-8 weeks. So if there's going to be a crash, the market has to form what looks like an intermediate bottom, and then that bottom fails and you go into a crash. So that's the scenario, the setup that I would be looking for in order to call a crash. The serial crash callers have been wrong all along, and I think they're wrong again. But those who are starting to see signs of a top here and a bear market down the road a bit, I think that's consistent with what I'm seeing. Next is a combination chart of the S&P 500, the lower portion here, and this is equal vertical width channels. Very busy chart, but there's a lot of information here. We'll take a quick look at this, and then at the top of the chart is the VIX plotted on an inverted scale so that it moves in the same direction as the price chart, and you can see the correlations really closely. But first, let's take a look at the S&P chart. Again, there's that long-term trend line where everything stopped on Friday, and now here on Monday we've got a pretty decent sized reversal coming off this trend line. Looking for resistance at around 1950 here on this chart. A rollover at that point again would form that weak right shoulder that I talked about earlier. Above this is a couple of momentum indicators, the 29-day rate of change, which theoretically represents the 13-week cycle. And let's draw a trend line right here. You can see that the trend was broken, but we've only come down to approximately the level of the April low where the market formed a bottom right here. Same thing on the 17-day rate of change, which is a theoretical representation of the 6-7 week cycle. Hasn't been very visible lately, that cycle. But again, it's come down to the level of the April intermediate low right here. This sell-off looks a lot like the one that we had back in April. So it shouldn't be surprising to see a bottom form in this area and get some kind of a rebound based on these two momentum indicators. Finally, at the top of the chart is the VIX plotted on an inverted scale with a couple cycle channels projected in. You can see that the lows, which were actually the highs, but they're plotted inversely, were broken. The lower projection channels were broken in mid-July and here at the end of the month. So this suggests a buy signal. Now these channels are probably going to roll over a little bit, but the chances are that this second spike down here is probably going to turn into a reversal, and this should turn into a valid, at least short-term buy signal. We'll see that validated one way or the other in the next couple of days. Lastly, I think there's some interesting information on the chart of the QQQ. And it's much stronger than the broader market, but there's obviously some very important leading stocks in this index, including Apple. And again, it came down to a very important support area around 94. The decline stopped right there at the convergence of a couple of trend lines. It broke another trend line, an equal vertical width channel line up here at about 95.50, but it couldn't extend from there. 94 seems to be support. Now, subsequently, if this trend line does break, once again, there's a big air pocket down to about 91. But as of today, anyway, it looks like this support is holding. We should look for resistance around 96, 97, and if not there, they'll probably go back up and retest the high where we'll see another rollover. So that is the technical picture. And I hope that gives you some perspective, a little more perspective than you maybe had before. I think there's a very good chance that the market is in the early stages of a top building process. We haven't seen confirmation yet from the indicators, but that could happen over the next couple of weeks. And again, I track that every day. Obviously, the market is a progression, and we try to stay on top of that in the Wall Street Examiner Professional Edition Market Update. Hope to see you there, and I'll see you here next week. We will go again on Monday. That'll be Monday, August 11th. Until then, trade sane. I'll see you next week.
This has been Radio Free Wall Street with Lee Adler. Find this program on the web at radiofreewallstreet.fm or wallstreetexaminer.com.